Question 25. On May 1st, Sereno Corporation reported the following account balances along with their estimated fair value. Okay, so we have their carrying amount and fair value, and for the carrying amount, they're actually the book value. And remember that when we calculate the consolidated balance, we are going to use fair value. And here we know, later you are going to know that Sereno is the subsidiary company, or the company acquired by another company. On that day, Zambrano paid cash to acquire all of the assets and liabilities of Sereno, which will cease to exist as a separate entity, which means that Sereno is no longer going to operate as an independent company. To facilitate the merger, Zambrano also paid $100,000 to investment banking firms, so that's like professional service fee. And one key sentence in this paragraph is this: Sereno will cease to exist as a separate entity, which means that it's going to be combined with the Zambrano completely, and it's not going to maintain its own book. Okay, so the following information was also available. Zambrano further agreed to pay an extra $70,000 to the former owner of Sereno only if they meet certain revenue goals during the next 2 years. Zambrano estimated the present value of its probability adjusted expected payment for this contingency at $35,000. So $70,000 is like additional payment if the Sereno is able to meet certain revenues target in the future. But its present value is $35,000. And this $35,000 will be considered as additional amount to the consideration paid to the subsidiary company's former owner. Sereno has a research and development project in process, which has appraised value of $200,000. So this is an asset that's not recorded on the book. In other words, it has a zero amount of book value, but its fair value is $200,000. However, the project has not yet reached technological feasible, and the project asset has no alternative future uses. Prepare Zambrano's journal entry, or prepare the journal entry for the parent company to record the Sereno acquisition, assuming its initial cash payment to the former owner was A, $700,000, B, $800,000. So that's kind of like two scenarios. And these two scenarios are going to depend on how much they actually paid in cash to the former owner. Besides that, contingent future payment. Okay, so let's look at the scenario A. Assume that the initial cash payment to the former owner is $700,000. If that's the case, then the total consideration paid in this scenario is going to be $700,000 plus the present value of that contingent payment of $35,000 equals $335,000 is the total consideration paid on acquisition date. And next, let's see what's the fair value of the identifiable asset and liabilities on subsidiary company's book. So the total value here equals to the total fair value of their total assets, which is given. So the fair value of their total asset is $1,345,000 minus the $106,000 current liability and $635,000 long-term liabilities. That's a two account over here. Those are two liabilities. We need to deduct that, and we also need to include this unrecorded research and development project. It has a fair value of $200,000. So total fair value of the identifiable asset and liability is $750,000. If we look at these two numbers, it looks like they paid less for the fair value of the subsidiary company. If that's the case, we consider that's going to be a gain in bargain purchase, equal to $735,000 minus $750,000 is a negative $15,000. Negative just means that it's going to have a credit balance. So that credit balance is a gain, right? So that's a gain. It's going to increase the firm's net income. All right. So next, let's prepare the journal entries. And the journal entry is going to be like this, because now the parent company acquired the subsidiary company, and the subsidiary company ceases to exist, and which means that we have to transfer all the asset account in the subsidiary company to the parent company, and also transfer all the liability to parent company book as well. So for the asset, from the parent company's point of view, they are going to increase those assets, right? So which means that we need to debit receivables, inventory, copyrights, patent technology. Those are the accounts we have on the subsidiary company book. Those are all the full accounts here. And include one more asset, this unrecorded R&D. And the debit amount is going to be their fair value. Those are all their fair value. Okay, so that's the fair value here. Remember that when we have this combination, we use the subsidiary company's account fair value. We debit the asset, and then we credit all the liabilities, and it's going to record their fair value as well. Okay, so that's those are all the accounts from the subsidiary company's book. And a few more things is this contingent liability, 35,000. That's because if the subsidiary company can meet certain goals in the future, then the parent company need to pay former owner 35,000. So that's like contingent liability. And then that credit cash, this is the total amount paid. So that's going to be deducted from the parent company book. And the last thing is this gain in this bargain purchase, because they paid less for the fair value. That's going to be considered as a gain to increase their net income. All right, so I'm going to use next video to give you the answer for scenario B. Question B. In question B, let's assume the initial cash payment is 800,000. And if that's the case, then the total consideration paid will be different. The total consideration paid is going to be 835,000. That equals to the initial cash payment, 800,000, and plus the 35,000 contingent liability. As to the fair value of the identifiable assets and liabilities they acquired from the subsidiary company, is still going to be 750,000, the same as scenario A. This part is not going to change. Well, now let's compare these two numbers. The total payment is 835,000. The total fair value is 750,000, which means that they kind of like overpaid for the total the fair value of the subsidiary company. The overpayment amount is 85,000. It's a positive number, that's like asset, and then goes to goodwill. Okay, so that next, let's prepare the journal entries to kind of transfer the subsidiary company assets and liabilities to the parent's book. And similar to the scenario A, we're going to record all the assets and liabilities that's already on the subsidiary company's book. Is include receivables, inventory, copyright, patent technology, research and development. Those are the assets from the subsidiary company. We're going to record everything with their fair value. And one more thing is the goodwill. Goodwill is the account that's created after this acquisition, 85,000. And then we credit all the liabilities that on the subsidiary company's book. It's current liability 180,000, long-term liability is 635,000. Okay, and then we credit the contingent liability of 35,000. And as to the payment, so there's a typo here, it should be 800,000. So we credit $800,000 cash. All right, so then that's the journal entry. If we compare the journal entries in these two different scenarios, the difference kind of comes from this part. So different comes from their total cash payment here. So if they actually paid more for the fair value acquired, then we're going to have a goodwill. Well, if they paid less for the fair value they acquired, then we're going to have a gain in bargain purchase. And also to say that if they paid more, then we debit a goodwill. If they paid less, then we'll credit a gain in bargain purchase.